Hi, thanks for inviting me. My name is Bradley Rutler, and I teach in the Philosophy and Religious Studies department here at the University of Wyoming. In the last several years, I've written a couple of academic papers on cryptocurrency and several op-eds on Bitcoin. I'm currently working on a book entitled Resistance Money, a philosophical defense of Bitcoin, with Andrew M. Bailey at ELN-US College and Craig Warmke at Northern Illinois University. Parts of this talk are taken from that forthcoming book. Specifically in this talk, I want to talk about where Bitcoin fits. We now have 20,000 new cryptocurrencies that have come out since Bitcoin, and a lot of them do a lot of things that Bitcoin doesn't do. And so one might wonder now, 13 years down the road, with all these new offerings, if Bitcoin has a place anymore. Add to that the dozens to hundreds of government-backed fiat currencies and commodities like gold and silver. What's Bitcoin's place among all of these things, among the fiat monies, among the commodities, among the cryptocurrencies? And in order to talk about that, I first want to talk about Esperanto. Esperanto is an amazing language. There's no irregular verbs. The writing system is phonetic. Pronunciation is easy once you learn the rules. It's almost certainly easier to learn than any natural language. And because of this, you might expect that when Esperanto was invented, people took to it immediately. They recognized its superiority as a language, and they learned to speak it, and they preached it to others who also learned, and the community of Esperanto speakers grew and grew. And you might think we're looking at a future where Esperanto becomes the only spoken or written language in the world. But that's not happening. And the problem is that nobody gives a shit. It's got wonderful features, but no users. And that doesn't work for languages. It may as well be a dead language. A living language doesn't just have a species, words, rules that govern how the words get put together, rules that govern how letters get put together to make words, grammars, etc. Dead languages have these. Living languages also have an active network, a group of people that are disposed to speak the language, read the language, create works in the language. And a living language needs both of these things. It needs a species and it needs a network. Money has a similar structure. There's monetary species, which is, the denominations of coins, bills, etc., bank deposits, how the money moves around, things like that, rules that govern how the money works and how it's divided. But then there's also the monetary network, the group of people that's disposed to accept the money, exchange the money. Money, like a language, is a network good. Network goods are things that grow in usefulness along with a growth in their user base. Think about the internet. If you were the first person to use the internet, you wouldn't get to see anything unless you had also created content for the internet, in which case you would only get to see what you yourself made. There's not much benefit to being the only user of the internet. There's not very much benefit, although there's slightly more, in being the second or third or 10th user of the internet. But as the amount of users grows, and as the content grows, each subsequent person benefits more and is more incentivized to use it. The more that people partake, the more that you gain by partaking. The more people are involved, the greater benefit you get from being involved. Languages are the same way. You're not very well motivated to learn a language that has 100 speakers, unless it's important to you culturally or historically or something like that. The odds that you will end up using that language are slim. You are, however, highly motivated to learn a language that 1 billion people speak, because it's much more likely that you'll use it at some point in the future. The problem with Esperanto is that it doesn't have a network. There aren't enough people who you can speak it with. Although it is brilliant as a language in terms of its species, it lacks as a language in terms of its network. You're no doubt thinking the parallel that I'm trying to draw between Esperanto and Bitcoin. Bitcoin, you might think, is a great species, but lacks the right kind of network. On the other hand, you might think that Bitcoin has kind of a big network, maybe surprisingly big, given that you think Bitcoin's, as a species, the design choices that it's made have been poor. Or you might think both, that Bitcoin has a small network and will fail as a species. So I want to look at Bitcoin as a species, as a network, and ask where it fits among the cryptocurrencies and fiat currencies and commodities that we see. This taxonomy illuminates not just how Bitcoin functions as money and whether Bitcoin is in fact a kind of money, but I think sheds light on what is good about being a money, what a good money looks like, such that if Bitcoin doesn't succeed, maybe we're better placed to invent a new money afterwards that might succeed. So looking at Bitcoin's design choices and the development of its network and the reasons that the design choices were made and the reasons that the network developed might give us a clue as to what people look for when they're looking for a good money. So again, the three elements of money. So far I've talked about only species and network, and I want to add a third. So the species, again, is some basic questions like, are there going to be coins and also bills? What denominations of coins? What denominations of bills? How many coins make up how many bills? And then the rules governing how the money moves around. Is the money going to be digital? Who's going to be in charge of creating the money? How much? Is it going to be backed by anything? These are questions regarding the species. Then there are factors regarding the network. Which people are inclined to accept this money in exchange for goods and services? Are there particular kinds of people that are willing to do that? What kind of people are willing to save this money for the future, thinking that they might use it then? What kinds of things do people want to buy with it? What kinds of people or which people are willing to denominate their wealth in terms of this money? And then I think an important third question is, how did the money come to be? This is a question about the founding. Was the money invented, like most fiat currencies are? Was it discovered, like most commodities are? Are there reasons to prefer a money that's invented over a money that's discovered? One of the things I want to suggest in this talk is that the founding is actually a lot more important for growing the network than people think. The story that one can tell about the founding of a money is important for inspiring people to want to use the money. So let's start looking at Bitcoin in relation to these other things. So fiat currencies are currencies usually backed by a government that have no use value, that aren't backed by anything, and importantly, for the purposes of how I'm trying to distinguish things today, have a zero marginal cost of production. You can print them for free. Now, of course, to print a $5 bill, it requires some linen and some ink and things like that. So it's not the case that the cost of production is absolutely zero for all instantiations of all of the money. But most of the money that's created today, most of the fiat money that's created today, is created digitally with the stroke of a key. And it costs nothing to add an extra zero or 2 zeros, or 9 zeros to the amount of money that's being created when it's done digitally. And so fiat currencies, in this way at least, have a zero marginal cost of production. Bitcoin, by contrast, has a non-zero marginal cost of production. And this was the case from the very beginning, too. Because the audience is at a blockchain event, I'm going to surmise that you know quite a bit about Bitcoin, so I'm not going to go into explanations of how Bitcoin works. But from the very beginning, Bitcoin used proof-of-work mechanism that required the miners of even the very first Bitcoin blocks to exchange money for Bitcoin in the form of purchasing energy with that money. So they had to get money from nature by expending energy. And the rules were the same in the beginning as they are now. So what distinguishes Bitcoin from fiat currencies is the cost of production. Bitcoin costs something to produce. Fiat currencies do not. Now, commodities cost something to produce. Gold doesn't just fall into your lap. It costs more to mine 10 tons of gold than to mine 1 ton of gold. So Bitcoin is like commodities in this way, that it costs something to produce. Where Bitcoin is different from commodities is in its non-monetary use value. So Bitcoin is worth nothing other than what it's worth as a money. You can't, like rub its shiny surface or enjoy looking at it or eat it or build a house with it or manufacture anything with it. Bitcoin doesn't do any of those things. In this way, Bitcoin is like fiat currency. Again, I guess you could burn dollar bills if you needed to stay warm for a few minutes or something. But certainly digital fiat currency is like Bitcoin in that they have no non-monetary value. So I think we might prefer to have a money that has no non-monetary value. Here's a reason to think that's the case. When you want to use something as a money that's also used for other purposes, you are competing to acquire that thing with others who want to use it for something else. And so its value is not wholly determined by its value as a money, but it's also determined by these other cases. So, for example, gold is used in jewelry. It's used in iPhones. It's used in monster cables. So when you want to acquire gold to use as a money, whether to store it or to exchange it for something else, you're competing with people who want to use it for these other reasons. And so you're paying a premium, not a monetary premium, but a use premium. You're paying more than gold's value as a money. And when you're buying an iPhone, you're paying more because Apple had to pay more for the gold because people use gold for things other than what gold can be used to its role in manufacturing. So no matter what you're using gold for, you're paying for this double value. And since you're never using it for both things, you're always overpaying for what you want it for. Using gold as money makes it more expensive for those who want to use gold as, a metal in manufacturing. And using gold as a metal in manufacturing makes it more expensive for people who want to use it as a money. Also, intrinsically worthless or monies that can't be used for anything else, they're very easy to store and send because there aren't these constraints on them needing to be useful in any kind of way. So just some reasons to think that when we are looking for a money, we should maybe be looking for a money that works as a money and doesn't work for anything else. So here's how Bitcoin fits in among other cryptocurrencies in terms of the species. Many other cryptocurrencies also have zero marginal cost of production. So think here of ICO coins like ETH and ADA. These coins were initially minted at zero marginal cost to their creators. Obviously, it costs something to, create the initial code, to buy the computers and things like that. But when it came right down to how many coins were going to be created for the ICO, it cost nothing to add a few more zeros onto the end. So other cryptocurrencies are like fiat currencies in that they have this zero marginal cost of production. The ones that share with Bitcoin the property of being costly to produce are the other proof of work coins, Dogecoin, Litecoin, etc. Coins that are, share it because they are copy and paste of the Bitcoin code with a few tweaked parameters, speed of blocks or supply. Cryptocurrencies are like Bitcoin in that other cryptocurrencies are like Bitcoin in that they don't have a use outside of the particular ecosystem. Now, some of the cryptocurrencies aren't just currencies. So some of the blockchains host non-monetary things. And I'm not talking about those. But cryptocurrencies that are just trying to be currencies have no non-monetary uses, but also, except for proof of work coins, have zero marginal cost of production. So we can see how Bitcoin is different from fiat currencies and commodity monies and other cryptocurrencies along various dimensions. So one of the ways that we can ask which species people prefer is by asking questions about the network. And one of the ways that we can learn about the network is by learning about the founding. So I want to transition to Bitcoin's founding as a lesson for how a money can be created and how that influences this network. So imagine that you wanted to create a new money and you want people to use it. So you don't just want to, come up with some money that you think is cool but not tell anyone about it. You want to make a money that people will use. It's not easy. You could start by creating a bunch of units of it and giving them to yourself, keeping them. Without doing anything else, you haven't made a money. You've made some things, but in order for it to count as money, at least someone else has to accept them from you. You have to be able to exchange what you have with someone else for something. And if you can't do that, it's not money. But how do you do that? You have to convince other people that what you're holding has some value. So if people aren't going to, accept them from you in exchange for goods and services, maybe you initially sort of seed the money out there by giving it away. Maybe you give it away to friends and family or something like that. The problem is then getting people to treat what you've given them as money because they got it for free. When you get something for free, you tend to value it at zero. It's hard to get people to start spending money on something that they're used to getting for free. And so you have succeeded in creating something and you've succeeded in getting it out into the world, but you haven't succeeded at making it money yet because the people who have it don't value it as money. You might start off by selling them. So you might keep none for yourself, but create them and immediately offer them for sale. But why would people be incentivized to buy them? Why would anyone think that by acquiring them, they can thereby at some point in the future trade them for a good or service or some other currency or something like that. Also, why would people trust you not to make more as soon as you've sold the ones you have, thereby diluting the supply and driving the value of each individual bit of money down? As long as it costs you less to produce the money than you can make from selling the money, you're incentivized to keep producing the money. So it's hard to see how you can bootstrap a money, how you can start up a money and get a network growing. Now, it's easy for states to do this because they can do it by force. They can, for example, refuse to accept taxes paid in any form other than a particular money. And therefore, you're incentivized to have at least enough of that money to pay your taxes. And other people, since they have to pay their taxes and the money, they'll accept it for goods and services, and eventually you've bootstrapped a monetary network. But for non-government-backed monies, force is rarely an option. These kinds of money have to rely on persuasion. They have to somehow convince people to treat what they have as a money. So here's how Satoshi Nakamoto, the pseudonymous inventor of Bitcoin, approached the problem. First, Satoshi wanted Bitcoin's initial distribution to be fair. Satoshi minted no Bitcoin for friends, family, didn't even keep any. Hold any back, get any in a way that wasn't available to everyone. There is and has always been exactly one way to mint and acquire new Bitcoin, and that's to complete proof-of-work puzzles, to trade electricity and processor cycles for Bitcoin by discovering the answers to the proof-of-work puzzles and publishing blocks. That was true in the original block, just like it's true today. Satoshi publicized in advance the existence of the Bitcoin network, said what day it was going to start, made the code available to everyone, and anyone who wanted to could have on that day been competing for the first Bitcoin block. So from the very beginning, the marginal cost of the production of new Bitcoin has not been zero. Now, obviously, it's increased a lot as more and more people have entered the competition to mine, but even from the very beginning, it cost something. As I mentioned before, not all cryptocurrencies follow this model. Some involve early rewards or pre-mines for their creators, for other insiders, for charities, for groups. So there, the marginal cost of production for these early coins is basically zero. And early insiders acquire their coins under different rules than others. Creators mint the units and then sell them. They don't trade something like energy or something else for them. And often the creators can keep well over 90% of the new coins, or keep/give them to others, or sell them. So the distinction here isn't immediately how many of the coins go to people who are outside of the inner circle. Plenty of cryptocurrencies have made them available, but always for a price, and the person that you paid was not the power company, as in Satoshi's case, but the creator of the coin. So maybe this is just fine. This is how shares in a company work. People who take the risk early on in a startup are rewarded with shares at a lower valuation than people who get in later. We tend to think that people who take risks and who are early to things, we tend to think that it's okay that they get preferential treatment. But there might be a different story when it comes to money. Money maybe should be more neutral, should reward insiders less. So perhaps people find it attractive when they learn that Satoshi followed the same rules as anyone else when minting early Bitcoin. Bitcoin's founding and initial distribution of coins is fair in a way that many others are not. And I suspect that Bitcoin's fair launch and initial distribution has played an important role in resolving the bootstrapping problem. So the bootstrapping problem was, if you keep it all for yourself, nobody's going to value it. If you give it away, nobody's going to value it. So if you sell it, nobody's going to want to buy it. So Satoshi did none of those things. Satoshi bought it originally, like anyone else could have. So that's one way of one aspect of Satoshi's solution to the bootstrapping problem, is the way that Bitcoin was initially distributed. Another aspect that I think plays a role is that Bitcoin is leaderless. Bitcoin has no leader. A creator's ongoing influence in a project always poses a risk, because you never know what that person's going to do. And you're never quite sure that you can trust them to do the thing that you would do. So earlier, I suggested that one of the problems with bootstrapping a money is people believing that you won't, as soon as you've sold the money that you've created, immediately create more money, because you'd always be incentivized to do that. So if you trust the creator, then you might do this. If you have to accept the edicts of the creator of the money, perhaps because it's a government whose borders you live within, you might accept that. But this isn't going to work for a private money whose acceptance occurs by persuasion. So Satoshi solved the problem in an interesting way, leaving. Without pomp or ceremony or announcement, Satoshi handed over the keys to the Bitcoin website and left. So nobody can worry that Satoshi will exert undue influence on Bitcoin's rules or distribution or anything like that. At least not under the Satoshi name or with the Satoshi influence. So in this way, Bitcoin has no leader. Now, of course, some companies benefit from having charismatic leaders. Elon Musk, Steve Jobs. These people use their celebrity to market for their company. But that can cut both ways. Anytime there's a figurehead, there's worries about what happens when you lose that figurehead, or when that figurehead starts saying things that you wish they wouldn't say. Bitcoin doesn't have that worry. And so this is the second part of Satoshi's attempted solution to the bootstrapping problem. So first aspect of the solution is Satoshi gets coins the same way anyone else does. And the second is Satoshi steps away and Bitcoin has no leader. So I've suggested that these aspects of Bitcoin's founding play an interesting role in Bitcoin's network. And you might wonder whether that's the case. And I think the answer is yes. And that can be seen in two different ways. First, Bitcoin has, for the entirety of its existence, been the most valued, the most studied, the most used, and the most widely known cryptocurrency. Many of the alternatives to Bitcoin have been around for a decade now. Their existence is no mystery. People can easily access them. And a lot of them can do a lot of things that Bitcoin can't do, and that Bitcoin will never be able to do. And yet, for some reason, Bitcoin retains the highest market cap. I suspect one of the reasons for that is that people prefer a leaderless money with a fair initial distribution of the coins. Second, Bitcoin currently has a unique and healthy distribution. For the entirety of its existence, Bitcoin has trended towards being more widely distributed. We can see this in two metrics. If you look at coin metrics and you look at the supply equity ratio, which is the ratio of, on the one hand, supply held by addresses with less than 1/10,000,000th of the current supply, to the supply held by the top 1% of addresses. So there, a high supply equity ratio means a high distribution of supply. And Bitcoin beats out all competitors on the supply equity ratio. I mean, I haven't looked at all 19,999 that are Bitcoin, but if you look at XRP, Litecoin, ETH, ADA, Bitcoin has a higher supply equity ratio than these. Particularly striking because Bitcoin is the primary crypto asset that's being custodied by large financial institutions. And that puts downward pressure on the supply equity ratio because as these huge corporations acquire higher amounts of the supply equity ratio goes down. So the fact that Bitcoins could stay so high despite the entrance of all of these large companies is quite surprising, I think. A second metric you can look at is the network distribution factor, which is the ratio of, on the one hand, supply held by addresses with at least 1/10,000th of the current supply to the current supply as a whole. So their lower is better. You want a lower ratio of people who have at least 1/10,000th of the current supply. And again, Bitcoin is lower than XRP, Litecoin, ETH, ADA. So more and more people are coming to own Bitcoin, a network that at one point was comprised of one person, Satoshi, has blossomed into a network involving millions of people. Of course, Bitcoin is nowhere near the level of most government-backed fiat currencies, certainly the major ones, but it's still relatively young, 13 years old. It remains a niche money for now, but it's trending towards wider distribution and more adoption. And one suspects, or I suspect, that has something to do with the initial founding. So we've been through the species, we've been through the founding. So what does the Bitcoin network look like? So the Bitcoin network has many different layers. Layer 1 is Bitcoin. Layer 2, a lot of people talk about as the Lightning Network. But layer 0 is people. The people who develop and support the Bitcoin ecosystem. Users, software developers, node runners, miners, hedge funds, venture capitalists. They often have competing interests. The Bitcoin software developers have a reputation for moving slowly, so as not to break things. Nodes that run different versions of the software risk having a chain split that creates a new ledger with a new cryptocurrency, unintentionally. So it's always really important that proposed changes don't split the network. But because of this tendency to move slowly, some people worry that Bitcoin is moving too slowly and being overtaken by networks that can do a lot more things. And so some people push for Bitcoin to move faster. Bitcoin's consensus rules have changed around 20 times. The changes occur less frequently as Bitcoin ages. There's only been one in the last 5 years. The software is open source, so anyone can, poke, prod, propose changes, but the proposed changes undergo rigorous testing, and they take a long time to implement. Because of this, Bitcoin software has a stellar history. The downtime is virtually non-existent over the last 13 years. Leading up to 2017, a civil war broke out in the Bitcoin network about whether to increase the block size for higher transaction throughput. So the big blockers, which included the biggest miners and a lot of the companies, argued that bigger blocks would help with adoption. It would increase the size of the network because the transaction fees would be lower. The small blockers argued that bigger blocks would increase the bandwidth and memory requirements for running a node, which would lead to fewer nodes and thus lead to more node centralization. It would also lead to more revenue for the miners who had the bigger blocks. The result was that the small blockers won. The node runners signaled an overwhelming commitment to reject larger blocks. And so the blocks stayed small. Today, there are around 40,000 Bitcoin full nodes operating around the world. That's more than quadruple the number of nodes on the Ethereum network. Ethereum nodes have high requirements. So a substantial portion of them are run on centralized servers. Amazon Web Services, at least when I wrote this, handled about 25% of the Ethereum workloads. I think that number has gone up since the merge. So Ethereum is more centralized. And the more centralized a network is, the more vulnerable it is to attack. Some criticize Bitcoin along these lines. They say that Bitcoin is also vulnerable because look at who wins the mining rewards. It's these 4 or 5 mining pools that are winning 70 to 80% of the block rewards. And anyone, given Bitcoin's proof of work consensus mechanism, anyone who can marshal 51% of the network's hash rate can start to cause some big problems. So one reason that Bitcoin is more decentralized than that statistic would show is because few pools have ever attained even close to a 51% of the hash rate. And it is trivially easy to switch the pool that your miner is operating as a part of if you feel like it's getting too big. And so this is what we've seen. As mining pools have approached 51%, people have left. So Bitcoin is also special in how people of all stripes, the users, the nodes, the miners, are committed to Bitcoin's automated issuance schedule. So this schedule has never changed in design, apart from some bug patches. So from the very beginning, the Bitcoin issuance schedule was coded into the software, and it is unfolded exactly how it was originally intended. Ethereum, by contrast, has had many monetary policy changes. Difficulty bomb, block time decrease, block reward decrease, difficulty bomb delay, and now a switch to an entirely different consensus mechanism. One reason for the copious changes in Ethereum's policies versus the minimal changes in Bitcoin's is due to the influence, the outsized influence of people within the Ethereum community. The presence and continuing involvement of Vitalik, as well as the Ethereum Foundation. These centralized sources of influence can exercise power in ways that individual users on the Bitcoin network are unable to. Perhaps the most famous example is the DAO hard fork in 2016, which left behind Ethereum Classic and instituted a new network, Ethereum, to undo an exploit that was permissible within the stated rules, but which resulted in unexpected and wide losses among DAO participants. You might think this is a good decision If you have the power to reinstate money that was stolen from people, then maybe you should do that. And in the Ethereum network, at least, there were people who had the power to do that. And so they did it. I'm not taking a stand on the moral question of whether that should have been done. But the fact that it could be done speaks to the centralization and manipulatability of Ethereum, which is the second largest cryptocurrency network. This would be impossible with Bitcoin because of Bitcoin's robust commitment to decentralization. But that commitment, I suggest, has led to more trust in the stability of the asset. And we've seen companies come in and indicate support of Bitcoin over and above these other cryptocurrencies, companies like Tesla and MicroStrategy and Square. And efforts to make Bitcoin legal tender in nation states like El Salvador and the Central African Republic. It's not because Bitcoin can do things that other cryptocurrencies can't do. In fact, it can do less. It has fewer features. But because of its founding, its fair initial distribution of coins, because of the way that rules can change, or rather, because of how difficult it is to change the rules, because of the fact that it doesn't have a leader who exerts any kind of control over the network, Bitcoin stands apart from these other cryptocurrencies. Because it costs something to produce, it stands apart from fiat currencies, which can be produced at will. It also, of course, stands apart from fiat currencies when it comes to things like the monetary policy and the issuance schedule. There are people who can change the monetary policy of the nation at will. And it stands apart from commodities because it is only good as a money. It also stands apart from commodities because it's digital, it's divisible, it's portable. And so for these reasons, I think Bitcoin occupies a special place in the monetary ecosystem. It stands apart from fiat currencies, stands apart from commodities, and it stands apart from other cryptocurrencies. Thanks.